Thank you for joining our webinar. Today we'll be discussing post-COVID trends in supply chain, transfer pricing, and customs in the Asia-Pacific region. I'm joined today by some of my colleagues from across Asia. We have Richard Bao, who is a tax and transfer pricing partner in Grant Thornton, China, based in Shanghai. Munjul Al-Mula, who is a transfer pricing partner with Grant Thornton, Singapore. And Richard Nutt, who is a partner in Grant Thornton, Australia, and leads the Custom and Trade Services practice. My name is Jason Cassis, and I lead the transfer pricing practice in Australia and the Asia region for Grant Thornton. Just a bit of housekeeping before we launch into the topic. This session is going to be recorded and will be available on Grant Thornton's website. Please feel free to ask any questions that you might have. We will do our best to respond to those questions during the session or at the end of the session. However, if we are unable to respond during the live session, we will respond via email. We have a lot to cover today. We'll start with current and emerging trends in supply chain before moving into areas that the authorities are focusing on in customs and in transfer pricing in our key jurisdictions of China, Singapore, and Australia. Finally, we'll bring all of this together with a couple of short case studies covering tangible products and debt and services and software to bring some of the issues to life. I have the easy job today. I get to talk about how things used to be. How things used to be before COVID-19 and before coronavirus. Before the onset of COVID-19, multinationals were already facing supply chain pressures on their strategies, on their management, due to factors such as rising manufacturing costs, technological disruption, and global tax changes. Many companies had been considering diversification or relocation of manufacturing activities to mitigate some of the effects of rising costs in their manufacturing locations such as China, India, Vietnam. And this was even before the uncertainties that were created by the trade disputes, particularly between the US and some of its trading partners. Another factor driving supply chain change during this period was nearshoring, or shifting sourcing and manufacturing closer to major operations and customers. This change was accelerated by the 2016 Paris Agreement and companies attempting to reduce their carbon footprint in their supply chain, as well as improving the responsiveness to customer demands and improving turnaround times. However, what these changes delivered was opportunity. It was an opportunity to restructure their supply chains, as well as the transfer pricing and the distribution of profits along those supply chains. Even before the impact of COVID on government budgets in the region, we were predicting a wave of tax disputes driven by the OECD's work in base erosion and profit shifting. The BEPS roadmap has handed to tax authorities both the transparency and the tools to go after undesirable corporate behavior. The work in the BEPS space has continued and is ongoing. And the OECD has recently delivered an agreement where multinationals will be subject to a minimum corporate tax rate of 15% from 2023, which has been signed by 136 countries. I'm now going to hand over to Munjul, who's going to talk about some of the emerging trends in supply chains through the region. Munjul?
Thank you, Jason. Yeah, I'm going to discuss how the impact of COVID has disrupted the supply chain and its impact on transfer pricing during this period of uncertainty. Because of COVID hitting various jurisdictions around the world, we've seen a huge amount of disruption in the supply chain with some of the people who are in the manufacturing space not able to sort of get to work, as well as international borders closing or sort of being impaired, which has really impacted the supply of goods cross-border. Very often in an M&E supply chain, we've seen a manufacturing company or a distributor or a super distributor heavily reliant on its related party or its affiliates for the supply of finished products and raw materials. However, with the disruption of supply chain and free flow of goods cross-border, especially in some of the jurisdictions, this supply from the related parties or from the affiliate suppliers has been impacted significantly, which has required our manufacturers or the distributors to seek alternate supply sources. Very often, these alternate supply sources may not be related parties, requiring the manufacturer or the distributor to seek supply from a third party within the sort of jurisdiction that they're located in, or any other jurisdiction where the flow of goods has not really been impacted that drastically. This also entails entering into pricing agreements and terms of agreements, which need to be factored in by the manufacturer or the distributor whilst renegotiating or renewing their sort of arrangements with their related parties. Since the arrangements with the third parties that they get into, even though it may be for a short term or the medium term, will impact transfer pricing matters vis-a-vis its related party arrangements as well. Not only are we looking at alternative supply arrangements, an M&E may even need to reevaluate its entire profitability within the supply chain due to such disruptions in the supply chain due to COVID. Very often in an M&E supply chain, we would see certain entities within the group who are structured as limited risk distributors, contract manufacturers, contract service providers, who are generally provided with a routine prefix and a guaranteed return. This COVID disruption will require us to sort of go back and take a look at the supply chain and the profitability therein to ensure whether, due to changes in functionalities, whether such entities would still require a routine return, and whether the sort of margins that we were sort of leaving behind in for such operations are still valid. Once these pricing arrangements are renegotiated, one would need to ensure that fresh intercompany agreements for supply as well as for services are sort of documented to ensure that the new terms and new pricing arrangements are factored into these intercompany agreements. Other than intercompany agreements, it's extremely imperative for the constituents of the M&E and the individual entities within the M&E to maintain robust internal documentation to ensure that whatever the impacts of COVID disruptions on their operations and businesses are appropriately documented and have been documented from and have been sort of articulated from a qualitative as well as a quantitative manner. So a lot of work that has to be done from a transfer pricing perspective vis-a-vis the COVID supply due to disruptions in the supply chain on account of COVID. Hand it over to Richard to sort of take us through the rest of the implications.
Yeah, thank you, Mutal. Excuse me. I think the trade protection and conflict had already recently reminded companies of the importance of strategically building redundancy throughout the whole supply chains. So the company's responses to those challenges were primarily limited to the movement of final operations that determine the origin of good. They face the current crises, and they are now relearning what they can do when they cannot get the raw materials, the components, and assembly lines necessary to make the product at all. So to counter the risk, it is very likely that more companies will build in redundancy at all phases of supply chain through regional specific chains. The trend of nearshoring is likely to accelerate under the COVID. It may counter the risk of trade protectionism and tariffs. It does not itself address supply chain disruption caused by COVID, by climate change, natural disasters, or political unrest, as no location is immune to the current contingencies. However, companies pursue strategic production redundancy. We expect much of this to happen close to home, as will drive other business benefits, such as, obviously, the shortened lead times, reduced logistic costs, and investment in local communities. Production redundancy, along with nearshoring in many places, means that production processes will be duplicated and dispersed, sometimes reducing cost-cutting benefits or economic of scale. So companies are already using logistic, overhead, and efficiency costs through digitalization and next-generation production technologies, which of all have their different tax implications in different jurisdictions. The COVID-19 pandemic has accelerated the process of digital transformation, which actually has long happened before the COVID-19 itself. The next generation supply chain must be fully digital, delivering transparency needed for both businesses and consumers who demand to retrieve relevant information from any point and at any time. When employing new technologies, such as AI and machine learning in the supply chain, multinational groups may want to consider the DMP function under the BEPS plan about intangibles, inherently undertaken by different group entities and different functions, different contribution to the IP, and to ensure the arm's-length allocation of results and profits driven from all the supply chains and different functions within the group. So I think this is pretty much what we want to share with you, the changes or what will happen next due to COVID-19. And I'd like to continue the conversation by sharing something with you regarding what is happening in transfer pricing arena for China, for Singapore, and for Australia. So for China, if we can have the next slide, please. China actually has a very mature and comprehensive transfer pricing regime back before 2000. So China never acknowledges that it follows the OECD TP guidelines. But if you can read Chinese, and if you have the time to read through all the transfer pricing regimes, all the laws starting from that time, you can see a high level of similarities to OECD TP guidelines. So the comprehensive guidelines of China, including compulsory documentation, we have APA scheme, we have CFC, ThinkCap, all those basic and quite advanced concepts are all included in the China framework. The latest changes, big change in the transfer pricing regime of China happens around 2016 and 2017, synchronized with the time when OECD released the BEPS action plans. So now the recent codification of China already echoes the BEPS action plans to have three-tiered documentation, DMPAP for intangibles, which we have already shared during the past slides, and also something like benefit tax for intercompany services. Country-by-country reporting is also in the China framework. So what we can see on the right-hand side of these slides is the latest developments in China. Some are written in the law, but some are just practical changes. We now have an exciting, a brand new speedy resolution for unilateral APA scheme. So APA as a scheme exists in China back in 2005, but there are some common concerns that APA application and the whole processing turnaround is quite slow in China. So the SAT of China just want to solve this issue. They have released this brand new speed resolution to give more pressure on tax authorities of all levels, especially on the provincial level, to get speedy resolution of unilateral APA. So now any application for unilateral APA in China can expect to get case down in 12 months. So this is a huge, huge boost of time. And we do expect a lot of interest from different taxpayers. And that is why we're just feeding calls every day almost regarding inquiries about unilateral APA here in China. And then the new trend about requesting extraterritorial value chain information about TP local file. So TP local file used to be just a routine, but starting from last year, tax authorities, they are just publishing new forms along with TP local file to collect more sensitive information regarding the whole supply chain, like the resale price of your intercompany and the purchase price of intercompany. So it all pinpoints directly to the most key value of transfer pricing. That is, what is China business doing and what is overseas business doing? Another thing is about the transfer pricing assessment of SAT. So SAT used to have a lot of formal transfer pricing audit. Now they are trying to move to spontaneous assessment by taxpayers. There are some MAP traps that if you want to do spontaneous assessment, these kind of adjustment might not be regarded as MAP applicable. So these are some China framework and developments. I'm not sure, Monjiao, if you have something new to share from the Singaporean perspective.
Thanks, Richard. Yeah. I mean, as regards Singapore transfer pricing, I mean, we're all aware that the Singapore had an extremely efficient tax rate, a global tax rate, as well as a fantastic incentive scheme. So, which is why, I mean, the tax authorities in Singapore and the IRAS, the revenue authorities, never really felt that there would be a need to have a robust transfer pricing regulations in the earlier days, which is why the first set of transfer pricing regulations that were released in Singapore was only towards 2005, 2006. And these were not very prescriptive in nature. They were largely guidelines that were provided to the Singapore tax authority, to the Singapore taxpayers, who were largely sort of under maps or APAs, etc., just to provide guidelines on how to go about their documentation, the approaches, methodologies, etc. Again, there was no mandatory documentation, no penal provisions, etc. So it was quite a tax-friendly measure, only to sort of guide the Singapore taxpayers. However, as time went by, the Singapore IRAS did observe that some of its key trading partners, as well as some of the jurisdictions within the region, were strengthening their transfer pricing regulations, and were also adopting rather aggressive practices during their audits, whereby a large number of MNEs, in order to sort of buy peace in these countries, were trying to take conservative transfer pricing positions in the other countries, whereby a part of the tax was being shifted out of Singapore through transfer pricing. Which is why over the years, Singapore has strengthened its transfer pricing regulations and has brought it in line with that within the region. Singapore now has mandatory transfer pricing documentation requirements, penal provisions, IRAS audits, etc., etc. From a documentation and a compliance perspective, while the compliance is not as onerous as we've seen in other parts of the world, there are provisions for a two-tier transfer pricing documentation, which involves CBCR, but that's only for Singapore-based or Singapore-headquartered MNEs. As well as there's a local file, again, for those entities or taxpayers in Singapore that have revenues in excess of 10 million, as well as there are transaction by transaction triggers, which are again quite modest. So if those transaction triggers are breached and a Singapore taxpayer has a 10 million revenue annually, it's only then that they need to maintain the local file. There's no separate requirement for a master file, but a significant content, a significant portion of the content that would typically be prevalent in the master file is now to be included within the documentation of the local file. So rather pragmatic approach taken by the Singapore tax authorities. We do have IRAS audits that have recently been introduced into the framework. Another feature of the Singapore tax transparent regulations is that they keep coming up with guidance notes for various industries or for specific types of transactions, which sort of guide the taxpayer. So very recently, they've come up with guidelines on the commodity industry, as well as guidelines for centralized structures within Singapore, which is again something that's quite common, something that we're going to see in our case studies as well, to sort of give some sort of assistance and help to taxpayers on the types of models that they may look at structuring for their centralized structures in Singapore, and the pricing arrangements that then can be adopted for these various structures. So all in all, again, pretty much like in line with OECD, still very pragmatic, but a bit more prescriptive than what was there initially. Hand over to Jason on the Australian transfer pricing regulations.
Thanks, Munjal. I know that I've spoken about the developments in Australia in a number of different forums, but Australia really has, the ATO has launched a coordinated attack on multinationals over the past 10 years, starting with new transfer pricing legislation, but then following on with new weapons such as the Multinational Anti-Avoidance legislation, as well as the diverted profits tax, as well as introducing transparency and disclosure measures such as the reportable tax position and country-by-country reporting, which is pretty standard across the region. A significant amount of energy, though, that the ATO is spending at the moment is around tax governance. Now, the tax governance umbrella is quite broad and includes corporate income tax as well as GST, but a significant amount of time and energy is being spent on transfer pricing, which has become a significant focus in tax governance. Now, the ATO expects that companies will have processes in place to ensure that management and board are aware of positions that fall outside of the ATO's guidance. Now, importantly, the ATO, by the sounds of it, very similar to Singapore, the ATO has significantly ramped up the level of guidance that they've been producing across a broad range of tax issues, but importantly, transfer pricing has received a lot of attention. The reportable tax position schedule, which requires companies to disclose their most contested or uncertain tax positions annually to the ATO, has been introduced for a large number of companies. Now, not surprisingly, the focus of the reportable tax position is very similar to the focus of the tax governance reviews that the ATO is carrying out. These are around financing and thin capitalization, hybrid mismatch and business restructures, as well as procurement and marketing hubs. It'll be interesting to see how the ATO guidance on procurement and marketing hubs aligns with the guidance that's come out of Singapore. Two important weapons that the ATO now has at their disposal, which is the Multinational Anti-Avoidance legislation, which is an extension of our general anti-avoidance rules, but has a particular focus on multinationals reporting revenues appropriate to Australia, rather than trying to reduce those levels of revenues through artificial and contrived means. The second one is around the diverted profits tax, which aims to ensure that the tax paid by multinationals in Australia aligns with the economic substance in Australia. Both of these measures have at their heart substance, the substance of the Australian business and what's being conducted here, and that the Australian business is being appropriately rewarded, something that is very hard of transfer pricing. I'm not going to talk about business restructures, because business restructures From an Australian perspective, from a TP perspective, they're very broad in what the ATO considers a business restructure. But be assured, if you're noting a business restructure through to the ATO as part of your international dealing schedule, it's likely that they're going to pay a bit of attention to that and come and ask some questions. Moving along to the next slide, I'm going to pass over to Richard, who's going to talk about some of the trade considerations. Richard?
Yeah, thanks very much, Jason. Look, as we discussed, more and more companies are considering to evaluate or change their supply chains or transfer pricing methodologies. This is really important that the interplay with customers really needs to be assessed in order to mitigate potential compliance risks with the various customers' jurisdictions or in customs duty payments. As part of the consideration, there is really three key areas that need to be considered. Firstly is the impact of free trade agreements. So as you're probably aware, there's a number of free trade agreements in existence across Asia, which are either regional or bilateral free trade agreements. So if I'm going to change where I'm sourcing my goods from or the manufacturer, one of the considerations that needs to be factored into the equation is this going to change the origin of my goods, especially if that manufacturer is actually sourcing raw materials from overseas countries. It might not meet the rules of origin requirements that qualifies the goods as a duty-free status in another country under a free trade agreement. The second condition to factor in is the direct shipment provision. So that is, if I'm sending goods overseas, whilst the goods are en route to another country, the goods cannot enter the commerce of another country. If you do that, you actually lose the entitlement to a duty-free import under most free trade agreements. The final one, and we'll actually touch on this point in our case study, which is coming up, is about third-party invoicing arrangements. So if I'm a manufacturer who's actually sending the goods direct to me overseas supplier, however, the goods are actually sold through a marketing hub in, say, Singapore, does the free trade agreement you potentially want to use allow for the third-party invoicing arrangement? The last point as well is distribution hub scenarios. So it's been quite commonplace over the years for companies in Singapore to create an actual distribution hub, which actually receives stock from various overseas suppliers from various countries. Can that hub actually factor in what they call the back-to-back certificate of origin process? If not, this could be very costly because potentially you lose the entitlements to a duty-free import if you can't produce the relevant certificate of origin. So that's the four key areas with free trade agreements. So now we'll look at the impacts of customs valuation and the impacts of transfer pricing. Well, firstly, if I'm going to change my transfer pricing, there's two questions to ask. Firstly, is it going to increase my cost on my customs value? If it is, potentially it's got an impact on my customs duty liabilities. If it's going to reduce my customs value, it could cause some compliance issues with customs because I'm reducing the value for which we're paying customs duty and any local goods and service taxes. The second consideration is if I'm changing my methodology to the transactional net margin method, which could potentially result in end-of-year adjustments that needs to be disclosed to customs. How does this sit with customs from a compliance perspective? It could cause some compliance issues in certain regions within Asia. The second point is about the royalties and distribution fees. These form part of the customs value. So if you create an invoicing flow, change your supply chain, that is going to trigger any royalties or distribution fees. How does this impact my customs value? Again, it's a case-by-case situation because each country treats royalties in a different way. The final point to consider is the impact of Incoterms. For example, if I'm using DDP, which is delivered duty paid to the end place, for example, into the warehouse or store, the importer record is typically under this true spirit of the definition of the Incoterm will be the overseas supplier, so they're going to be responsible for paying any GST and customs duties. However, if that's the case, the transactional value cannot be used in the customs landscape. So that's an impact from a compliance perspective. Or alternatively, with more and more companies actually change to Ex Works because due to the impact of COVID increasing freight rates, they can better manage supply chain costs and also the scheduling of goods. So that's the three areas I wanted to touch on from a customs perspective, global trade considerations. So how does this work from a practical consideration? So as we mentioned on the next slide, please, we're going to look at a case study. So this case study is going to step you through the tangible movement of goods. So essentially what we're going to look at here in the case study is firstly a manufacturer of the product or developed products in China is going to ship directly to the overseas supplier in Australia. The Australian supplier will then distribute the goods to the domestic market in Australia. However, the manufacturer is not actually selling to the distributor in Australia, he's actually selling the goods to a marketing company in Singapore. So before handing over to Richard, who will talk about the implications, I just want to touch on what's the customs considerations. Well, firstly, I mentioned about the third-party invoicing arrangement. That's a big one because potentially, if you can't accommodate this scenario under the free trade agreement, it increases your customs duty liabilities. Are we going to be factoring in any royalties or distribution fees? If so, it's a consideration for the customs value. And thirdly, what's the impact to the customs value under the new transfer pricing methodology, which I touched upon? And with that, I'll hand over to Richard. Thank you.
Yeah, thank you, Richard. So actually, we can see from the China perspective. Next slide, please. China used to be very reliant on contract manufacturing businesses. So we are manufacturing hub for many multinationals for the goods and products. So the tax authority used to have the concern that the overseas headquarters or entrepreneur, they undercompensate China for the contract manufacturing businesses. Now with the step up of the China business, there are self-owned manufacturing, R&D in China. There are more and more outbound investment by China entities. So this is the real world scenario, just like presented in this case. So the challenges from the China perspective can be different. So it's the change of the trade wind. So now the tax authorities, they are more liable to challenge if there's any loss for this Chinese headquarter company. Even if it's very clearly in this case, China as the manufacturer, as the R&D owner, as well as the lender to the Australian entity is the entrepreneur of the group, while maybe the Singaporean entity is just like limited risk distributor. But if the whole business retains a loss in China, the tax authority might still challenge if this kind of loss is fair, or has it been resulted from a non-arm's length arrangement for the pricing between China and Singapore. So all in all, the Chinese entity needs to be wary about the whole supply chain arrangements, be you a contract manufacturer or in this case, an entrepreneur. So in the China scenario, being an entrepreneur does not give you the immunity from being challenged if it's a loss position.
Yeah, brilliant. I just want to probably take on from where I think Richard left out, and for Singapore considerations. Again, I think Jason made a pretty important point in one of the earlier slides that substance is important and imperative in analyzing supply chain pricing arrangements, and this would be true even in Singapore. So from a Singapore perspective, whether the characteristics of the entity in Singapore, which is mentioned out here as a marketing hub, could change drastically depending upon the substance and the people functions that are parked in Singapore. It could either be structured as super distributor, it could be characterized as an entrepreneur, or just a sort of support service provider depending on the people, the skills, the management, the IP, etc. vis-a-vis the entity. Again, depending on the characteristics and the people function within Singapore, it could be sort of remunerated, or the pricing model could entail Singapore either being left back with a residual return if it was structured as an entrepreneur, or taking a buy-sell based routine return if it was a super distributor for the APAC, or if it was just a sort of a pass-through providing the support and coordination services, it could get just a sort of a service-based return. So once again, substance is key. for determining the pricing model and the remuneration in Singapore, and what would need to see the actual roles and responsibilities and the value that's generated by the Singapore entity vis-a-vis the entire supply chain and the value chain within the group. Over to Jason.
Thanks, Munjul. I just want to touch on two considerations from an Australian perspective. The first is around the returns to the distribution function, and the second is around the financing. As I mentioned before, the ATO has recently released some guidance around distributors, which has essentially codified the profit expectations of the ATO for distribution functions, categorizing it into high, medium, and low risk. For general distributors, what does that look like? Well, for general distributors, it means low risk is an operating margin above 5.3%. Medium risk is an operating margin between 2.1% and 5.3%. And high risk is below 2.1%. What does that mean? Well, it means that if you're low risk, the ATO is probably going to leave you alone. But the truth is there's not many distributors in the Australian market earning 5.3% operating margins, particularly in the current environment. Medium risk, what does being categorized as a medium risk mean? Well, it probably doesn't mean that much change from what you're experiencing currently. It means the ATO is going to monitor you and they're going to ask some questions. So what was happening previously is probably going to happen on a go-forward basis. High risk, well, high risk, the category has expanded out. So previously high risk, we would have said was 0% or negative or losses being incurred in the Australian company. So that's now 2.1% and below. And what does that mean? Well, it means that the ATO is going to be actively asking questions and monitoring your activity. It's going to be interesting to see how this plays out, given the current environment, given the current low distributor returns that we're seeing in Australia. There's going to be a lot of companies that are sitting in this bucket of high risk returns. The second issue I'm just going to touch on briefly, and that's around financing. So similarly, the ATO has released some guidance around financing. Similarly to the distributors, they've taken very much a risk approach. So the risk approach considers both the pricing of the debt facility, as well as the motivational factors to shift those profits offshore. And you need to look at it for each separate related party debt facility. Now, what does this mean from a practical perspective? Well, from a practical perspective, it means that it's really easy to have debt finance that's considered high risk from an ATO perspective by having some very simple terms and conditions. By having a loan that's denominated in non-Aussie dollars, by having exotic features such as promissory notes or interest deferrals on these interest rates, immediately take it into those higher risk categories that potentially you do need to tell the ATO what your self-assessed risk rating is. So it is important to understand. What does it also mean? It means that related party debt finance is no longer a set and forget in Australia. It needs to be reviewed annually based on the commerciality of the related party loan. And it's particularly relevant in the current environment where low interest rates are readily available across the globe. So those are the 2 points that I wanted to make. I think I'm handing over to Munjul, who's going to take us through very briefly the second case study.
Thank you, Jason. This relates to software, and as we all know, IP is a very significant aspect of the software. So this will sort of touch upon that as well. So this case study involves a Singapore-based company that's owning IP in a particular software. Though Singapore is the owner of the IP, it does not sort of conduct its own R&D, but it outsources the R&D to company A in Australia and company C in China for providing certain software development services. and hence owning the IP from such efforts of the Australian and the China companies. Once the software is owned by the Singapore company, it then uses or sort of engages in distribution arrangements with company C and company A in China and Australia, who then act as distributors for distributing the software products to the customers in their respective regions. So that's the case study. And now we'll sort of analyze the potential challenges that may be faced vis-a-vis this particular case study. Next slide, please. Right. Now, from a Singapore perspective, it becomes very imperative to sort of demonstrate that the company that's there in Singapore is the legal plus the economic owner of the IP. And that can be sort of demonstrated by showing or showcasing that the entire DEMPI-related functions are sort of housed in Singapore, which would probably include the conceptualization of the IP, the design of the IP, and as well as the arrangements that they have with the Australian and the China company are largely on a contractual basis, wherein the companies in China and Australia who are conducting the R&D and the contractual development function are doing that at the behest and on the instruction and guidance from the Singapore entity. So that needs to, so we need to showcase from a Singapore perspective as, that all the key decision makers relating to the development of the IP are based in Singapore and are taking all key decisions, even though the actual contract R&D and the development work may be outsourced to Singapore and to China and Australia. Further, even vis-a-vis the distribution operations, one again needs to sort of like showcase from a Singapore perspective for Singapore to be entitled to the residual revenues that the arrangements with Australia and China are akin to a limited risk distributor, where the companies in China and Australia are pretty much acting as limited, are just acting as sub-licensors to the particular IP that's held in Singapore, and all key decisions regarding the pricing, the distribution terms, etc., are taken by Singapore. If the Singapore entity is unable to demonstrate such functionalities and such substance within Singapore, it would be very difficult to sort of demonstrate that it's entitled to the residual revenues, which is the sort of like, you know, moot point in this case. Hand over to Jason to sort of discuss the Australian TP implications on this.
Thanks, Munjal. I wanted to touch on two issues from an Australian perspective. Because of the time, I'm not going to talk about the diverted profits tax, but with Singapore in the supply chain, diverted profits tax absolutely needs to be a consideration. The first point that I wanted to probably speak about was the R&D services. So again, the ATO's released some guidance around R&D services in dealing specifically with these DEMPI functionality around intangible products. So DEMPI refers to development, enhancement, maintenance, protection, and exploitation of intangible properties, including software. And the ATO's concern, again, is that the Australian company is being properly recognised and rewarded for its activities within the development, enhancement, maintenance, protection, and exploitation of this software. In short, where you disclose to the ATO, either in country-by-country reporting or in your international dealings schedule, disclose to the ATO that you're receiving R&D service revenue, you need to expect that the ATO is going to come and pay you a visit. Where we've seen companies come unstuck is where previously Australia was the owner of the IP, but through a business restructure, the Australian company is now providing R&D services to an offshore IP owner, But the reality is that there's been very little change in the Australian business, both in terms of the operations and employees. That's going to be a big red flag for the ATO. So R&D service revenue is a space that we're going to see a lot more activity going forward. The second thing I wanted to talk about is withholding tax on the sale and distribution of software. Now, I spoke in the last case study around distributors and the guidance for inbound distributors that the ATO has released, and all of those same comments, they apply here. But the additional consideration is withholding tax. So the ATO has issued a draft ruling recently on software and royalty withholding tax. And it contends that all or part of the receipts from the distribution and licensing of software are royalties and therefore could be subject to withholding tax. So this is the sale or resale of software that is the prepackaged software, digitally distributed software, or cloud-based computing such as software as a service. All of these are impacted. So companies that are going to be very broadly impacted are companies that have this software at their core of their revenue generation. So it's important to note this is only draft at the moment, and so it's still evolving as we see. And one thing that the ATO hasn't really dealt with through this draft guidance is the impact of Australia's tax treaty network. However, what you can see is they're codifying a lot, they're expanding the code around withholding tax, which sorely needed updating. I think it was originally put in place in about 1993, and strangely, it may come as a surprise, but things have moved on in the last 20 or so years in software. So they're probably the two issues that I wanted to talk about. I'm going to hand over to Richard Nutt just to talk about some of the Australian customs implications before we talk to Richard Buck.
Yeah, thanks, Jason. So I think one quick point on royalties, it goes without saying it's an implication for customs is royalty payments. So that potential would need to form part of the customs value where possible. It's going to be cost and customs duty implications, and non-disclosure of this to customs, even if it's just GST that was payable, it is an offence under the Customs Act in Australia, as it is in New Zealand and most other countries. So I think that's the key observation regarding the royalty and withholding tax issue that Jason was talking about, is real customs implications. And that's the only real point I've got on the software part there. So with that, can I hand over to Richard for the China considerations?
Yeah, thanks, Richard. I think from China perspective, when we talk about any cash repatriation to overseas, the preliminary consideration should be given to the fact that China is a forex control country. So that means once we want to repatriate cash, we need to fall into buckets. What is the nature of this transaction when we pay the cash? So sometimes because of, or in more often the times, despite of the legal clauses that describing the business nature of the intercompany commercial agreements, there can still be controversies regarding software-related transactions. For example, in this case, when the Singaporean entity licensed the software, licensed the use to Chinese entity, will it be viewed as China buys software, or it's a pure licensing or royalty-related transaction, or even is it a bundled service transaction where the Singaporean entity provide management as well as technology services to China? These all matter in China because, like I said, they can fall into different routes of repatriation under the China Forex control rule. So if we package that as buying software, then the payment will be made via China customs. While if we say this is a royalty transaction, licensing transaction, service transaction, you will need to file tax and file all the papers with China tax authorities. So these two authorities, while they all acknowledge the arm's length nature of intercompany transactions, can have very different concepts or thoughts regarding the pricing components itself. So this is point number one. The second point I'd like to resonate what Jason just mentioned from Australia perspective regarding dumping. So nowadays, it's more and more happening is that China Tax Authority, for a contract R&D business, if it's standalone, then the focus is quite simplified. Whether you use like cost plus and whether the plus is good enough for the contract R&D provider like in China. But if it's a complicated transaction, first China provide contract R&D services, then you transfer the ownership to Singapore. Back then, Singapore will license this IP back to China. Then the tax authority might be more interested to know the connection between these two. So they might want to challenge the one-time transaction contract R&D services, whether during that service, the China entity has been compensated enough, because the future licensing amount to be paid from China to Singapore can be potentially much larger than the original fee received by China on the contract R&D. So their challenges can be from a pure business logic perspective, or they can simply quote the dumping functions to say, although China is labeled legally as a contract R&D provider, but all the dumping functions fall heavily under China. So they might want to revisit the licensing transaction and especially the pricing mechanism. So this is pretty much the reality in China regarding all those software or IP related transactions. Now I'd like to hand over to Jason for any summary of this case, or if there's any questions from the floor.
Thanks very much, Richard. We have had a couple of questions that have come in through the presentation that I'll ask of Munjul and Richard in China. The first question to Munjul, I think, is around, there's a few questions, but broadly it's, can you talk to the trends in audits in Singapore, and what are the key flags that are triggering an audit within Singapore?
Right. Fantastic. Good question. So the audit trends in Singapore are just picking up. So around a few years back, they were very sort of infrequent, but we have seen a lot of questions on transfer pricing being raised in the course of your routine tax audits, and there have been sort of special transfer pricing audits also sort of coming through in the last few years. A large number of the red flags that sort of really raise questions on transfer pricing or sort of a special transfer pricing audit are usually when there are significant losses in a Singapore-based company, or if they see a huge spike in the value of intercompany transactions vis-a-vis the previous year, as well as if they see fluctuating profits within the Singapore entity. So it's largely got to do with your financial performance and inconsistencies in your profitability on a year-on-year basis.
Thanks very much, Munjul. I think broadly, it's a very similar question that's being asked of you, Richard, around trends that are going to trigger an audit in China. But in particular, I think there's wanting to understand what an audit in China actually looks like. What sort of information is going to be requested?
Okay, thank you. I think in China, we have two broad buckets. One is called the formal audit. The second is called spontaneous review. So the formal audit has been in China for around 20 years, where it's very strict. So it will be like governed centrally by SAT, the highest level of tax authority in China. A lot of questions will be asked. A lot of information will be obtained, not only about the China financials and China operations, but more about information along the whole supply chain, as well as maybe the consolidated financial of the group. So a lot of things, and about the functions and risks and allocation of people. And if your group has country by country reporting, definitely there will be something of primary interest to China tax authorities. So if some taxpayers is unfortunate enough to be subject to a formal audit, it used to take a lot of time. So the average time for a case from opening to close is around 36 to 48 months. So it's a lengthy time. Nowadays, starting maybe from 4 or 5 years ago, China tax authorities, they are changing their mindset a little bit. So they are migrating the formal audit more and more to spontaneous review. That means they give more leeway to Chinese taxpayers because China tax authority, they have a very strong big data system to identify and transfer pricing risks from all the filing information or the filing sheets of the taxpayers. So if they sense something might go wrong with the transfer pricing of Chinese entities, you will give the chance for the Chinese taxpayers to review by themselves, to spontaneously give adjustment plan, if applicable, and pay up the tax. Then if that's something reasonable, then this taxpayer might be immune from future formal audit. So this whole spontaneous adjustment period is much shorter. Maybe you can just close the case by 2 or 3 months. But the downfall of this is that if the spontaneous review will anyway result in a significant amount of transfer pricing adjustment, this number cannot be used as a credit during a future MAP process because it will not be qualified for MAP, given the reason that it's spontaneous rather than it's SAT enforced. So there are good things and bad things about spontaneous adjustment.
Thanks for that, Richard. Now, I think we've probably got time for one further question. We'll have to respond to all of the other questions via email following the session. One final question, I think, to Richard Nutt. We've had a couple of questions come in about year-end adjustments that might be occurring in distributors or companies within Australia to help them achieve a particular operating margin, 3%. And they come at the end of the year rather than as the goods are arriving through the year. The questions, I think, broadly boil down to how do you deal with that from a customs perspective? These year-end adjustments on products coming into Australia that's going to alter the cost of goods sold.
Yeah, Jason, it's a good question, sir. I mean, look, first and foremost, there is an obligation under the Customs Act in Australia and most countries that these needs to be disclosed. And there is a formal mechanism to make that disclosure. Firstly, with the Customs Valuation team, you need to apply for a valuation advice ruling in respect to your transfer pricing. Once that's been finalised with that relevant section, you then can proceed to make the disclosure to Australian Border Force. And then if it's in a refund scenario, you can then go and amend all the impacted transactions for that period and seek a refund of customs duty. Or if it's increasing the customs value, you have to make a one-off payment to customs. And that's very similar to New Zealand and a lot of other countries as well. At least there is a formal mechanism here in Australia to report those, Jason. Failure to do so is actually an offence under the Customs Act and can lead to penalties. So, for example, one penalty is about $9,500 per offence.
Penalties always gets everybody's attention. Absolutely. Thank you very much for that, Richard. I think we might take this opportunity on behalf of all of the presenters this afternoon to thank everyone for taking the time to attend this webinar. Please, if you have any further questions that you haven't asked during the session, please don't hesitate to reach out to myself or any one of the presenters. We'd be happy to have a conversation or an email with you. But in the meantime, thank you very much for attending, and we look forward to talking with you all soon.
Yeah.